As the global economy slows and worries of mounting trade wars rise, the Federal Reserve has announced that they will leave rates unchanged and signalled some flexibility on their balance sheet rundown programme going forward. That balance sheet currently standing at $4 trillion. This change in tone is in stark contrast to their statements in December that sent markets spiralling downwards and has been welcomed by both investors and President Trump himself, who has warned against Fed Chair Jerome Powell's proposed rate hikes as being overly bullish and potentially damaging to the US economy. In a press conference, Powell has stated, though, that the revised strategy is not a result of political pressure or indeed the US economy, which he noted was solid, but instead related to a number of other cross-currents. These cross-currents include slowing growth in both Europe and China, uncertainty regarding any potential trade wars, the government shutdown, which, let's not forget, is on a 3-week break, not actually resolved, and also in the UK, Brexit. The Fed will adopt a wait-and-see approach regarding any future action that they may take. It is worth noting from his speech that Jerome Powell seemed to feel that these cross-currents might be around for a while. Dismissing the idea that a damaged global economy could be good for the US, Powell stated that, ultimately, a strong global economy is good for us. We export to these countries. We trade with these countries. He pointed out that part of the strong economic performance in 2017 had been as a result of the improving growth outlook for the rest of the world. In Powell's view, the US does not win when the rest of the world suffers. He also noted that they had been waiting for the appearance of any inflation risks before raising rates. But given that inflation has been persistently weak, this could be some way off. In a news conference following the central bank's decision to hold its benchmark interest rate steady, Powell stated, "The case for raising interest rates has weakened somewhat. We believe that we can best support the economy by being patient in evaluating the outlook before making any further adjustment to policy." He continued, noting that, in light of global economic and financial developments and muted inflation pressures, the committee will be patient as it determines what future adjustments to the target range for the federal funds rate may be appropriate to support these outcomes. US stocks and Treasury bonds rose on the statement, with the Dow Jones up 1.73% on the day, the Nasdaq climbing 1.5%, and the S&P rising by 2%. The language used by the Fed has even led some to speculate that the next rate move may not be a rise at all, but instead a move back downwards. Investors in general were happy with the new language used by the Fed relating to both the economy and its intended monetary policy going forward, with many feeling that its previous plans for reducing the balance sheet had been contributing to market volatility.